It's Masters Week, and to me that means the spring has started, and for the next 6 months, everything gets better, except for perhaps the stock market. Let's dig right into the chart room and see what we learned this week. So we're looking at here at the world interest rate probability screen on the Bloomberg terminal, and what we can see for the May 3rd FOMC after all the data that we got that came out this week. Really, the expectation for a rate hike of 25 basis points at the May 3rd meeting is still around a coin flip. Earlier on Thursday, it was down around 44%. We closed the day at 52.6, as you can see there. But very, very clearly, by January 2024, about 100 basis points of interest rate cuts are priced into the curve. And by December, 75 and maybe 100, right? So, that expectation of rate cuts still from every Fed speaker that we've heard this week was, no, we're going to get to a slightly higher level and we're going to hold it there until inflation comes down and is under control. And for them, that means core in the 2 to 3% range. And when I've looked at the numbers, I think it's going to be very hard to get there mathematically this year, especially if wage pressures remain high and if we see that uptick that we've seen in energy prices kind of stick. When we look at the long end of the bond curve, right? So TLT is the ETF that represents long-term treasuries 20 years plus. This chart pattern we're looking at here is very much bottom-like. You've got this triangle forming where it's pretty clear there's strong resistance at 110. Every time we've been up there in recent months, it's been rejected. But on every sell-off, the buyers seem to be coming in at higher lows. Last week, actually, we bought the dip in here. We had sold previously above the 200-day average. We bought back. We're now. So question is, does the long end break out? And if the long end breaks out, we're going into a recession. That's what the bond market is telling us. If this pattern plays out bullishly, technically this target would measure up to about 120, where the next resistance is. You could make an argument that could break up to almost as much as 130 if we take the base of that triangle and measure it on to the breakout. So what needs to happen for the long end of the curve to fall 75 to 100 basis points, right? To me, that's a pretty hard economic landing. And when I checked my sources and asked around, all that money, that imbalance on bank balance sheets, the regional banks that they bought, all in here and all that bond is going to be for sale. So that this liability mismatch, estimated to be somewhere between $200 and $600 billion of assets that are not marked to market, hold to maturity kind of thing, that are causing a lot of the stress, would be for sale, and they would reprice their book and rehedge their book. So there's going to be a tremendous amount of supply for sale up here. So those of you who look at a chart here and say the long end's going to rally to 130, I would say probably no. Now, again, asking, can we get to 120? So again, you look at what that is, and it's approximately another, 35, 40 basis points in the long end. So that would take the 30-year that went out at 355 and put it at 320-ish. And that would take the 30-year at 330 and put it under 3%. And to me, that would be, again, pricing in a much harder landing. If long end yields are going that low, then they're convinced inflation is going to come down pretty hard. I don't think we're going to see that. So while we might break out a little bit here, I don't think that that's going to play out. Now, the higher for longer story from the Fed, this is looking at the December SOFR futures. And remember, the SOFR market is replacing the Eurodollar market. February's FOMC, the higher for longer message. SOFR curve for December sold off. This came down to 94.50, which would imply that by December, Fed funds would be 5.5-ish range in terms of, these aren't Fed funds, this is bank risk. So call it Fed funds at 5.25, bank risk at 5.50. And then the bank crisis hit, and all of a sudden, basically 100 basis points plus started price into the ease. You can see that all the data misses economically over the last few weeks, we'll have a look at that in a second. All the data misses of the last few weeks, we saw these spikes up to 96.5, which would imply by December a 3.5 Fed funds rate. There's no chance, no how, no way that Fed funds is going to get to that rate unless the economy falls off a cliff and inflation comes crashing down. And that's what the bond market is trying to tell us. And if that happens, there's no way equities should be trading at 4,100 on the S&P, because that's a hard landing. And I get that the Fed would ease at that point, but that ease is not stimulus, it's relief. And the multiple for equities really shouldn't be higher. So this lack of breadth rally we've seen this year, where a handful of stocks are responsible for all the gains in the market, where the bottom 90% of stocks on average are flat to down on the year, tells me this is not something we want to get bullish on. So finally, the last chart we want to have a look at is the Citi Economic Surprise Index for the US. And so this is an indicator where they say, what's expectations for various economic data points, and did we beat or exceed them? And so since about mid last year, on average, the economic surprises turned positive, where you'd start to see more surprises than disappointments. And so for the last half of the year, around neutral, where some were surprising to the upside, some were to the downside. But we've seen this in the first few months of the year, where economic surprises have been to the upside. What we've seen in the last couple of weeks here, and this will include the recent and massive redoing of the initial claims data. Those of you who follow on the week-to-week stuff, initial claims, there was a 5-year revision where effectively they revised up significantly what the average weekly claims were. And so by no means are we at a point where you would say recession for sure. But when we look at the ISM surprise, now negative to the downside, everything else, in the last few weeks, we've seen the surprises come pretty hard to the downside. And when you go back and look historically at a graphic like this, and go back, 20 years or so. So let's go back to 2003. Obviously you can see up in this range, you tend to hit a peak of economic surprise impact, and then down below -50, the opposite. So right now, the best of the economic surprises is in the rearview mirror, and most likely what's in front of us, typically once this starts to come down, the economic surprises start to come on the downside. And so when you line that up with weekly indicators and everything else that we're looking at, including the inverted yield curve that is pointing us to a recession with the negative ISM prints, we're almost certainly going to see that economic fall off. So as earnings season starts this week, pay very, very close attention to what these systemically important companies are saying. FedEx was a bit of an anomaly there, but we heard from Costco this week, and they're saying margin pressures, and they're saying okay, we've got to cut costs. That means headcounts. The labor situation is going to start to relieve some pressure from the Fed, so that's a positive, but not from the perspective of the economic pain that Main Street still needs to feel well into 2024. And historically, remember, folks, the equity market doesn't bottom until we get 2 or 3 rate cuts. And what I'm arguing is those rate cuts aren't coming in 2023. It's going to be a 2024 market bottom in all likelihood, where we're likely going to see some pain or at least a retest of last year's lows later this year. So in terms of, again, caution being the message on the bear side, lighten up, whatever that means for you in your portfolios, buy some put protection, whatever. I love ratio put spreads right now, where you buy 1 unit of a put, sell 2 units of the puts on the names you want to own. Do those at a slight credit so you get paid to wait. You get a yield in your portfolio. Put the money in money market, get a lot of cash right now, where cash is not trash anymore, and wait, make some money on the pullbacks, and then expose your portfolio to buying the names you want to buy, but at much better levels than they're trading at today. That in itself is both the bull and the bear pick of the week. Have a good one, everyone.